First, let's talk about what everybody has been discussing the last little bit, and that's the federal budget that was announced by the Liberal government. It took the spotlight away from all the talk about the carbon tax for a little bit because everybody was anticipating what was coming out. So let's talk a little bit about some of the main points. They went after the capital gains inclusion rate. They increased it from 50% to 2/3, which is 66.7%. Their mission was to attack the wealthy, and they claim that this will only impact 0.13%, less than 1% of the Canadian public, to make up for a big lion's share of the revenue. I don't know how much of that is true because there's a lot of folks that inherited properties from their parents that passed on and have now a secondary unit they're renting out. That capital gains inclusion rate impacts them if the gain is over $250,000. So I'm not sure if their assessment that it only impacts 0.13% is actually correct. Second thing they really stressed is a housing plan. They gave us little anecdotes of the housing plan. They're going all in on trying to create incentives to build more homes. There's obviously a significant gap, and they're planning to build 3.9 million homes by 2031. They also went after junk fees. There's going to be some legislation that's going to attack junk fees, and I think this is a good thing. They want to get rid of these useless charges that telecoms charge for switching carriers, airline companies, and concert ticket charges that seem to be just gouging. And one of the things that they want to do is they want to limit NSF fees that banks charge to $10, and also provide a grace period to someone who doesn't have sufficient funds to have a check clear, to allow them that opportunity to bring it current and not bounce that check. So I'm really interested to see how the banks react to that and whether they will pass on other fees some other way to consumers with monthly charges for bank accounts and stuff like that to make up for it. So I'm really, really interested to see how that plays out. But that's one of the good things. One of the highlights too was savings for post-secondary education. They are going to be creating an RESP for any child born after 2024 in a low-income household that's based on parental income. They're going to give up to $2,000 via the Canada Learning Bond. And I think that's a good thing. I think that's probably something that people could look forward to and get their child's education off on a good start. But let's talk a little bit about some of the key points here. The capital gains tax, for those that want to pick on the wealthy, that don't pay their fair share, they think that this is a good thing. And that's going to be really interesting to see how it plays out, because now folks that have the capacity to invest are now going to be looking for a higher return because of the increased tax rate. So will there be a flight of capital to go to other jurisdictions to invest their money? We'll see. You could pick on the wealthy all you want, but they're the ones that create jobs. They start companies, they invest in businesses and try to build new innovative technologies and stuff like that. And if they're going to be hit over the head at the tax time, I think it's going to maybe change their appetite for investment, and especially in real estate. This budget was heavily weighted with housing. And you have to incent people to want to invest in housing. And when you have capital gains taxes increasing, there could be a reluctance and no incentive for this type of investment to happen. So, in speaking to a couple developers in the last 48 hours, they're basically going to sit on their hands. They're going to say, well, I don't know if I really want to develop my land. I'll just wait and see if there's any repeal of this tax. And there isn't any urgency to risk their capital in an environment that, number one, is inflationary, number two, has high interest rates, and number three, their biggest challenge is there's no defined timeline to get permits at the municipal level, because it's still a huge, huge challenge. So I'm not sure how effective this plan is, but one thing that I have an issue with is that there was billions and billions of dollars poured into infrastructure spending, trying to reduce the process, but only $100 million put towards skilled trade training. Okay, $10 million was going into trade education and enhancement, and $90 million into apprenticeship programs. That is the real problem. We don't have enough skilled trade workers to build all these homes that they're hoping to build by 2031. We have a large chunk, I think it was like 35% of skilled trades that will be retiring in the next 5 to 7 years. And that poses a tremendous gap. And if you have to import and bring in non-permanent residents in the skilled trade category, you still need homes to house them. They can't live in the communities where they're building in because there's just no homes and there's just no affordability to be housed in those homes. We have seen a government that's put out and sprayed money out all over the place trying to get groups of and blocks of voters to think again about voting for them. And the amount of debt that they have incurred is alarming. Okay, we are now looking at a $40 billion deficit. And here's the kicker. $46.5 billion is going towards paying off the interest on our deficit. And that will be going up to north of $60 billion by 2027 as bonds and whatnot mature, and they gotta renew them at a higher rate. This is alarming because it's almost the amount of money of the healthcare transfers to the province, which is $49 billion. And to put things into perspective, the amount of money collected in GST is the equivalent almost to the amount that we're paying in interest on the debt today. So when you pay that GST, that goods and services tax, it's going towards paying off the interest alone on our federal debt. We got to cut some spending. We can't be spending more. We got to cut expenditures. We got to start getting efficiencies, and in no way is all this spending going to curb inflation. You know, we're seeing gas go up again. The carbon tax is going to factor into the cost of goods, and we're going to continue to see that that inflation rate be very, very sticky. And I think that this Bank of Canada is looking at all this and saying, guys, I don't see a hike anytime soon. So anyone that's anticipating a drop in interest rates anytime soon, I think we're probably going to be prolonging any type of cut. It really puts the Bank of Canada in a very tough position because, quite frankly, the spending's just a bit out of control. And I don't know if they're spending it in the right places. On to inflation. Inflation came in at 2.9%, a 0.1% increase over the previous month, and not moving in the right direction. There's some core inflation numbers were positive, but the reality is it's not heading down to 2%, which gives a lot of evidence to the Bank of Canada that we're still not ready for a cut in rates. The bond market rallied a little bit. It's still in that range, not necessarily moving down. It's actually moving the wrong way. Our Canadian dollar's taking a beating because of the spending. And this could cause a prolonged recession. You know, unemployment's creeping up. We're going to start seeing more job losses. People are going to start cutting salaries, cutting jobs, and we're going to hear more and more of it over the next few weeks. So prepare yourself. Be ready and be aware that this could be a long road. Discovery math was introduced by the Liberal government in the province of Ontario about a decade ago. It was all based on estimates, and it was the strangest thing. I personally had difficulty trying to grasp it because, quite frankly, helping my kids do this didn't make any sense to me. What they found in the EQAO testing is that grade 6 math students in the province of Ontario, only 50% met provincial standards. This has got to be the lowest of the lows. when only half of people can deal with the curriculum of a grade 6 student. Like, this is bizarre. We got to get back to basics. We got to start teaching financial literacy. Like, how much hope do you have in kids that have a 50% pass rate in grade 6 math? We need to get back to teaching kids the basics. So I'm really excited that they're going to be turfing this Discovery Math campaign and focusing on teaching kids how to add, subtract properly, and how to understand how interest rates work, how to budget, and how to make sure they don't run out of money before they run out of month. Because if there's one thing I see on a daily basis in my brokerage, is the number of people that are struggling, number of people that are really at wit's end trying to make the numbers work. I digress a little bit on that, and I'm hoping that we start setting the foundation with our youth to teach them proper math, get back to the drawing board of focusing on education, and get rid of all the feeling stuff and all this bullshit that I think is an absolute disaster. We got to teach kids important things, math, science, technology, if you want them to succeed in the future and grow the economy with these tools. So hopefully we could get that. On that note, let's tighten the chin strap on the helmet and let's get into your questions. How soon should an upcoming mortgage renewal be shopped in the marketplace? Okay, this is always a good question. The standard is 120 days. There's a few lenders that offer 130 days. But I always encourage people to call us at least 6 months in advance so we could start collecting the documentation, start assessing what options you have, so we could be ready to start shopping for you at the maximum amount of time. And that acts as a bit of an insurance policy, because if rates do pop from that time, 120 to 130 days prior to maturity, you will benefit with the lower rate. This is something that's been quite active in the current marketplace as people are in shock dealing with the new interest rates from what they're maturing from, especially from 5 years. We're seeing a lot of people in the 249, 289 range coming up for renewal, and they're looking at 4s and 5s and in a bit of sticker shock. So preparing them 6 months in advance allows us to, go through the cycle, make sure they still qualify at the new qualifying rate plus 2%, and make sure that all the stress test qualification criteria is met, so they have a chance at securing the lowest rate in the marketplace. We're all here to help out in any way we can to get you the best rate. Give me a call. I'd love to help you. I always encourage everybody, come in for an espresso. Okay, we're almost at, I think we're 7,000 espresso served here at OwlMortgage. Pop in, 3250 Dufferin, just south of Yorkdale, Unit 4C, big sign up top. We always got the espresso machine on. We got bags and bags of beans, okay? So we're never short of espresso. So pop in and say hello. Have you seen an increase in power sales in recent months? We're seeing a high number of power sales. It's becoming quite challenging as, usually it starts off in the private world in the alternative space. There's a lot of folks unable to keep up with the higher interest payments. A lot in the alternative space, we're at, $299, $399 on a 1 year, and they're coming up for renewal seeing 7 and 8% interest rates for a 1 year term, and it's just choking them. It's causing considerable stress, and in some cases, because it was only a year or two out, values haven't gone up for them to refi or even shop, so their loan to value has gone backwards and they're not in a position of strength, which is causing them some problems. So we're having a lot of calls from folks needing help. They're struggling. Lawyers are seeing more power sales. Other MICs are seeing a lot of power sales. There was about 300 power sales on MLS, which is starting to creep up as more and more are on the system. Now, a lot of them get sold, get repriced and whatnot, but he said it was about 300, so that's quite a bit. So what type of programs would you propose to help solve the Canadian housing crisis? Oh, somebody's putting me on the spot here. That's a really good question, and one that I've had many discussions with folks about, but one of the things that I believe is missing, and that is a strategy that incorporates all the existing programs. And let me explain. You know, we have the First Home Savings Account. It allows people to contribute $8,000 per year to a maximum of $40,000. It's a 5-year plan. That contribution creates a tax refund, which could go back into an RSP, and you now have the government has increased the RSP home buyer program from $35,000 to $60,000. So if people have a plan and have a long-term outlook to save money over the next 5 to 8 years by utilizing both First Home Savings Account and the RSP program, and then incorporate a strategy where if they buy a new home, because they introduced this 30-year amortization on high ratio, and they buy a new home and that builder identifies what the input costs are on that new build. So these are all the input taxes, all the development charges, all the parkland dedication fees, all the levies charged by the cities, all the development, every charge, HST, every charge that goes into that house. And the government says, listen, if you buy this house, all those development charges, we'll give you a loan for that. And your mortgage would only be based on the cost of the home and the developer's profit. So, you know, the argument is 30% of a new home's cost are input taxes. So let's say on a $750,000 home, those development charges are $225,000. So if a client has $100,000 down payment and they qualify for a high ratio mortgage with 30% with 30-year amortization, the government will give them a loan for the $225,000 that were charged in development charges. So the borrower doesn't have to pay interest on all those taxes that were incurred by municipalities, provinces, and the federal government with all the input taxes in that product. And let's say that government forgives 1/15 of that amount every year, provided that home buyer stays in that home. So all of a sudden it creates stability in a community, right? They really drill down on making sure they build communities that people want to stay in. You are getting some forgiveness of that promissory note that doesn't have any interest, and the client is really only paying interest on a mortgage of about $400 and change as opposed to $600 and change. Like, I think if you can incorporate all the programs together and provide an opportunity for a first-time buyer to benefit from buying a new construction home, then you also have developers that are willing to cater to that first-time buyer by building something for a long-term community. It seems complicated. It would involve a lot of levels of governments to play ball, but I think there needs to be some cohesiveness amongst all the programs available to come up with a strategy that allows people to buy with confidence and not feel that their mortgage obligation is just drowning them in debt. Okay, so that's something that I would think about, and gives builders the ability to sell to first-time buyers that don't have the 20% down payment for their deposit schedules, and it allows the government to support builders who are looking after first-time buyers. It's an all-encompassing plan that would encourage people to use all the tools available to them so they can find a path to home ownership with confidence and knowing they're taking advantage of a government program that's going to give something back to them for supporting builders. A little bit complex, but that's how I like it. I think there's a way if there's a will. And I'd always be happy to attend any focus groups, any brainstorming sessions at the government level to introduce stuff like this, because I think you need people that are in the weeds every day that see the struggle of Canadians and what the challenges are to come up with some solutions. So I didn't mean to bore you with that, but that's my take on it. What is the advantage of the First Home Savings Account? It's a new program. I think there's 750,000 accounts that have been opened up, and these are folks that want to buy their first home. They could contribute up to $8,000 per year to a maximum of $40,000 over a 5-year period. That contribution acts like an RSP deduction. Okay, so If you contribute that $8,000, it'll be deducted from your income, so you get a tax refund. Take advantage of it if you are a first-time buyer. I think it would be very helpful to anyone that wants to take advantage of that opportunity to get a tax refund to accelerate that savings.